State Bank of India has reported its highest ever quarterly net profit, beating street expectations with a more than 24% rise over the previous year. Net interest income also grew 9%. Asset quality saw an improvement. Fresh slippages are down, and the credit cost for the quarter is at barely 0.29%. To decode the quarter that's gone by and the way ahead, joining me now is Mr. C.S. Setty, the Chairman of State Bank of India. Mr. Setty, always a pleasure to have you here on CNBC-TV18. Highest ever quarterly net profit is what you reported. We also understand that includes a special dividend from SBI Mutual Fund. If you could clarify on that, and also total business crossing 103 trillion. What led to this exceptional performance from SBI, and can you sustain this momentum going into FY27?
Thank you, Ritu, for having me on your show. Yeah, I think even beyond profit, as you mentioned, we broadly have taken care of every parameter in terms of, or I would like to rephrase saying that we check the boxes which are relevant, both in terms of asset quality, in terms of margin maintenance, and also in terms of the growth, business growth. The business growth is also is not restricted to one particular segment. We had holistic growth across business segments, whether it is RAM, corporate, all of them have contributed to the growth, which has resulted in the NII going up by 9%. One important thing I would like to mention that we also had focused on, moderating the cost of resources. We have focused on retail deposit growth. If you see the 14.5% retail deposit growth rate, and our CASA continued to be robust, current account growth rate of 10%. So this has ensured that our cost of deposits are contained, and this has contributed to the NIM. And as far as which is the net profit has been a combination of contribution coming from the increased operating income and also moderating the operating expenses. As far as one-off is concerned, I think even if you do not consider the dividend, special dividend, what we have received from the AMC, we still have a very good comparable growth over sequentially as well as year on year. As far as this special dividend is concerned, it's part of the capital optimization efforts what the AMC has done, and the special dividend was declared, and we got our share of 2,200 crores.
So, what really stood out for me was the kind of credit growth you've been able to report of more than 15% in the quarter. What drove this kind of a growth? And going into FY27, could you give us a guidance on where you'll end FY26? Would it be significantly higher than 12 to 14%? What would FY27 look like? And what will drive this kind of a growth?
So as I mentioned, the credit growth has come across the sectors. Every business segment has contributed. In fact, the corporate also had rebounded almost to 13% corporate credit growth, and across RAM segment, every segment of RAM has contributed double-digit growth. In terms of the guidance, yes, we are upping the guidance from 12 to 14 to 13 to 15% for the current financial year on an aggregate basis. I don't want to go beyond the current quarter. I think we need to look at, there are so many positives in terms of the trade deals, in terms of the budget announcements, in terms of the monetary policy related announcements. I think everywhere I see a greater opportunity for State Bank of India. We are present both domestically very strong and also cross-border opportunities internal to us in India, as well as cross-border opportunities are significant for us. So I believe that bank is well positioned to sustain this growth momentum. So the guidance is for the current quarter, that 13 to 15%, as against 12 to 14% what we have previously given. I think we will come back probably in the next quarter in terms of the full year guidance for FY27.
Sure, sir. But on such a large base that you already have, 13 to 15% kind of a growth, would the RAM segment alone drive that? Or do you think corporate would also have to pick up in a meaningful way, especially now going ahead? Of course, it hasn't started yet. M&A financing, REIT financing, all that also coming in. Do you see a higher, corporate credit growth as well, driving growth for SBI going ahead?
corporate credit growth, we expect that double-digit growth rate will continue. In fact, my guidance for the Q3 was that we will do lower double-digit, and I think we have substantially exceeded that guidance. We've almost reached 13.5% as against our expectation about 10 to 11%. So I believe that the corporate credit growth will be double-digit, will be continued in the current quarter also. And the trade deals will definitely help in terms of primarily the US deal has removed the overhang on the tariff side, which is extremely positive in terms of increasing the sentiment for the investment climate. So I believe that the double-digit growth rate on the corporate will continue, while RAM will still be doing the heavy lifting in terms of the credit growth.
Okay, RAM will still be doing the heavy lifting for growth, but what about the deposit side, sir? Are you seeing some of the pressure ease, with some of the liquidity-related measures that RBI has also announced in the past few months? 57 trillion is where you're at. You're growing 9% year on year. Where do you hope to end FY26 as far as deposits are concerned?
I think we should be growing at 9 to 10%, but our focus would be moving away from the high cost wholesale deposit to the retail term deposits on the fixed deposit side, and continue to focus on the savings bank. We are the largest franchise on the savings bank balances, right? And we continue to have a clear engagement at the branch level to mobilize this low cost current account and savings bank deposit. Even in a very difficult environment for current account, the bank has recorded a 10% growth rate on current account. We are the largest holder of the current account balances, which means that our strategies in terms of mobilizing the deposits is paying well. And in the process, we are not going overboard in terms of increasing the cost of resources. We are containing the cost of resources. If you see, our cost of deposits have actually moderated and is giving the pickup in the NIM and the pickup in the NII.
Okay, so just a quick word on this headwind of trade deal. That overhang being kind of gone, at least waning with the US deal, some of the contours becoming clearer, the EU FTA kicking in hopefully next year. Your MSME book is already at 26 trillion rupees. Firstly, in the last 8 to 9 months, when there was this overhang of tariffs, was there any stress build up that you saw in the portfolio? And going ahead, do you think you could grow the MSME book in a more meaningful way with this overhang out of the way? Perhaps high teens, in the 20s? What is the expectation?
So if you see our pure MSME growth, their overall MSME, what we call MSME is around 21%. There could be some segments or exposures which are not classified as corporate coming into MSME. But if you take pure MSME, our growth rate is about 18%. So my view is that the trade deal and the positivity which the trade deals have created are equally beneficial, if not more. As much as corporates will get benefited, MSME, downstream industries also will get benefited. In fact, in the US trade deal, much of the benefit actually is available to the MSMEs, whether it is textiles, apparels, or shrimp cultivators. They're all small enterprises, and they got really benefited. And apart from the positive environment which is coming out of the trade deals, the information and the data availability on the MSME is very robust now. And we are able to devise and design the underwriting models which gives confidence of lending to the MSME. That is also one of the reasons why the uptick on the MSME side. I believe that 18 to 20% growth rate in MSME at the system level will continue.
Okay. So finally, two quick stats, if you could give us. Credit cost for 9 months has come down to 0.39%. We've seen an improvement in the slippages Q on Q as well. What kind of an improvement could you end the year with, with the SMA book also seeing a bit of an uptick? And secondly, on margins, safe to say they've bottomed out and we see it trending up from here on?
I still would like to stick to my guidance earlier given, Ritu. I think we are sticking to the NIM of about 3%. For the current, the full year NIM would be around about 3%. And on the credit costs, I think our earlier guidance was 50 basis point. We are still sticking to it. There are not going to be any surprises on the asset quality side.
All right, sir, thank you very much, for patiently answering all of those questions. It's been a pleasure chatting with you. Thank you very much again.
Thank you, Ritu.